Recently, a villa was sold in Dubai in 15 seconds, not through a real estate agency, not through a bank, but through blockchain. 1,000 investors from different countries became co-owners of the property without paperwork, a notary, or a month of waiting. Now here's the question. Why do we still have to spend 30 days gathering references, paying thousands of euros in commissions, and signing 40 documents to buy an apartment? Blockchain is already changing the real estate market, not somewhere in the future, but right now. Today, I will show you how NFT shares, tokenized rentals, and crypto mortgages work, where they are actually used, how much you can earn, and how to do it all safely. If you want to understand how real estate is becoming a liquid asset accessible from your phone, watch until the end. Dubai is no exception. In the US, a typical house has already gone to a new owner through NFT faster than the first contract is printed at the notary. Let's look at this case first. In 2022, the Roofstock on-chain platform conducted one of the world's first real estate trades in NFT format. A single-story residential house in South Carolina was sold through a smart contract, without banks, without notaries, and without the standard week-long wait. The buyer paid for the house in USDC, and ownership was transferred via NFT, instantly, within a single Ethereum network block. The most interesting thing is that this trade included registration, transfer of rights, and legal confirmation of ownership, all automatically. The buyer was left with a token that confirms ownership and allows them to dispose of the property, rent it out, resell it, or use it as collateral in DeFi. For comparison, in a traditional trade, such a process would take 3 to 6 weeks, including negotiations, signing contracts, bank tranches, and confirmation from regulators. Here it all came down to pressing a button. The purchase, signing, and transfer of rights took a few seconds. Roofstock didn't just list the property on OpenSea. The entire legal structure of the transaction was adapted to the token. The company created an LLC, limited liability company, for each house, and it was this LLC that became the object encoded in the NFT. In other words, the token represents legal ownership through the company. Everything is done according to the law. The main advantage is liquidity. Such a token can be resold on the marketplace, transferred to another investor, or even used as collateral for a crypto loan. This makes real estate a much more flexible instrument than the classic paper model. The platform continues to evolve and now offers tokenized homes in various states, including Texas and Florida. The entry threshold is a few $1,000s, and rental income is automatically transferred to the owner's wallet in USDC. Imagine that real estate can be bought as easily as Tesla shares. You take your phone, press a button, and now you own not a whole house, but a part of it that immediately brings in money. This is already working, and it's called NFT shared ownership. Until recently, investing in real estate required either a lot of money or a mortgage for years. But blockchain has opened up a completely different approach. Instead of buying an entire property, you can buy a small share and earn rental income without having to manage it. This is how the Realt and Roofstock on-chain platforms work. They divide real estate into digital shares in the form of NFTs, which are then traded on marketplaces. For example, with Realt, you can buy a share of an apartment in Detroit for as little as $5,100 and earn 16% per annum in USDC every week, right into your wallet. There is no paperwork, no lease agreements, and no direct communication with tenants. Everything is automated through smart contracts. Income comes in automatically, and the token itself can be sold, exchanged, or even used as collateral for a loan in DeFi at any time. In practice, it looks something like this. You open the Realty marketplace, select a property, a house or apartment, look at the yield, and click Buy. From that moment on, payments start coming into your wallet. Moreover, if the property increases in value, your token also increases in value, and you earn on two fronts, both from rent and from the increase in the value of the property itself. By the way, if you want to understand more deeply how to create such a token, we have a separate video called How to Create Your Own Token, the link to which will be in the description. Now that we understand how real estate is transformed into a mobile asset, it's time to move on to crypto mortgages. Did you know that you can use Bitcoin or Ethereum as collateral to buy a real house without selling them? Let's take a look at how this works in practice and which platforms already offer this service. In the traditional world, mortgages are slow, complicated, and tied to your credit history. But in the crypto world, things are different. Here, the main thing is the liquidity of your assets. If you have Bitcoin or Ethereum, you can use them as collateral and get a mortgage without selling your crypto and without going to a bank. One of the first services to do this was the Milo platform. It works with clients from more than 90 countries and issues mortgage loans in cryptocurrency in up to 100% of the property value. Basically, you put up, say, 1 BTC as collateral and get money to buy a house in the US without selling your asset. These loans don't require proof of income, credit history, or tax residency status. Everything is based on collateral and the current price of cryptocurrency. If the rate falls, there is a risk of liquidation, but if the asset grows, the collateral becomes safer. All this works on the basis of smart contracts and with complete transparency. You can see the parameters of the trade, LTV, interest rate, and manage your position through your personal account. Interesting fact, in 2025, the US took the first step toward officially recognizing these models. The federal regulator FHFA told mortgage agencies, Fannie Mae and Freddie Mac, to consider digital assets when reviewing mortgages. This is a sign that the market is changing, and crypto is getting more involved in the real sector. This trend is still gaining momentum, but the fact remains, with cryptocurrency in your wallet, you can already buy a real house. No bank, no paperwork, no unnecessary explanations. Now it's time to move on to the most interesting part, how you can make money from this. Because tokenization is not just about technology, it's also about income, and stable income in USDC without the headaches of rent and taxes. The most striking example is the Rialt platform. Let's say you want to buy a share of a house in Detroit. On Rialt, the minimum entry amount is approximately $5,100. You simply go to the website, select a suitable property, check its yield on average 6.16% per annum, and buy a share, paying in USDC via a crypto wallet, such as MetaMask. From that moment on, you will automatically receive rental income in USDC every week. For example, if you invested $1,000 and the property's yield is 10% per annum, you will receive approximately $1.92 every week. It may not seem like much, but let's calculate it for a year. That's already about $100 in net passive income, and that's from just one property. Want more benefits? NFT shares can also be used in DeFi. For example, Rialt tokens can be pledged on platforms such as RMM or Aave and used to obtain a low-interest loan, usually around 4% per annum. So, if you have $1,000 worth of real estate tokens, you can get an additional $500 loan secured by these tokens. This amount can be invested in another property, increasing your return. Yes, NFT shares generate income, and it all looks convenient and modern. But digital property is not only about new opportunities, but also new types of vulnerabilities that are important to know about in advance. Let's look at 3 key threats you need to be aware of before investing your money. The first is token theft. If you hold NFT shares in a regular wallet without protection, they can be stolen just like regular crypto assets. At the end of 2023, a vulnerability in Ledger Connect Kit allowed hackers to withdraw tokens and NFTs worth more than $600,000 in a matter of minutes. And the worst part is that it is impossible to recover the assets. The blockchain is irreversible. So if you are investing a large amount, use a hardware wallet. The second category of risk is problems with the real estate itself. Realty, one of the most well-known platforms in this field, faced lawsuits from the Detroit authorities in 2025. It turned out that dozens of properties had not paid taxes and had serious violations of housing maintenance standards. As a result, token payments were temporarily suspended, and share prices fell by 10–12%. This shows that even if there is a token, there is no guarantee of a stable flow. That's why you should always check the payment history, the presence of tenants, and, if possible, publicly available data on tax debts and the status of the property. The third risk is regulatory. Many jurisdictions have already begun to recognize tokenized real estate as a security. This means that projects operating without a license may be restricted or blocked. For example, the SEC in the US has explicitly stated that if you sell a share in a real asset through a token, it falls under securities laws. To avoid falling into this trap, choose platforms with a license or status in a regulated sandbox, and keep your tokens in your wallet. If the platform restricts access, you will still be able to manage your assets. All this is no reason to be afraid, but it is something to take into account. As in any field, if you understand how the system works, you won't lose out. But risks are only half the picture. There's another side, land that cannot be touched, but for which millions are already being paid, competing with prices for real apartments in central London. Let's figure out why a digital plot in the Metaverse is becoming not a toy, but a serious asset for investors. Virtual land in Metaverses is worth millions of dollars because the number of plots is strictly limited by a smart contract, and demand for the best locations is constantly growing. For big brands like Gucci or Nike, Virtual plots are a chance to reach millions of users around the world, hold events, sell digital goods, and test new products without any physical costs. That is why plots on the main streets of Decentraland and the Sandbox are more expensive than apartments in prestigious areas of London or New York. Investors buy virtual land for resale, on the wave of hype, or for passive rental income. For example, a plot in Decentraland can bring in thousands of dollars a day if a major event or virtual conference is held on it. Such trades are fully automated through smart contracts and require minimal effort from the owner. As a result, virtual land is becoming an asset that generates real profits for both large companies and private investors. While technology is changing the real estate market, you can start with something simple. If you hold SOL, check how staking works via the Telegram bot at Solana Staking IO Bot. It shows the yield, validator status, daily accruals, and immediately notifies you if something goes wrong. Everything is in one place. Convenient, understandable, and without the need to manually check dozens of websites. Today, we saw how blockchain reduces real estate trades to seconds, turns shares into streaming income, and even sells virtual plots for more than bricks. It all comes down to one thing. Where there is scarcity and demand, new liquidity is born. And here's a question for you. Which models seem the most promising? NFT shares in real houses, crypto mortgages under Bitcoin, Ethereum, or virtual land? Write in the comments. In the next video, we will analyze how blockchain and AI are starting to work together, from price forecasts to contracts that update rental terms in real time. Subscribe so you don't miss it.